Very excited to welcome all of you to another NEO Spotlight, where we profile our asset managers, public companies, and exciting products and initiatives on the NEO Exchange. Today, I am very pleased to be joined by Elliot Scherer and Alex Jatan from CIBC to share some timely information about one of our newest products taking over Canadian DIY investors and financial advisors' accounts, Canadian Depository Receipts, or CDRs for short. A warm welcome to you both, and thank you very much for joining me over lunch today.
Thanks for having us.
Yeah, thank you.
Pleasure. Elliot, Alex, 132 trading days since your launch of your first CDR. You now got 18 of them in market, listed on NEO. Your fifth launch last week. A lot of really cool things going on. I know our audience and I certainly excited to hear the update today and share with the crowd about CDRs have been innovating access to capital markets. But before we get into the presentation, big crowd, and I'm sure all of you have heard of CDRs, but for some of the folks who might be new, maybe Elliot, turn it to you first to share with our audience exactly the inspiration behind CDRs and how they compare with their US cousins, American Depository Receipts.
For sure, thanks, Eric. Yeah, it's a good place to start. So CDRs are a Canadian security that allow Canadian investors to buy shares of global companies in Canadian dollars on a Canadian stock exchange with a built-in currency hedge. So CDRs were first introduced in July. So when we launched the Amazon.com CDR, and they're now 18 trading on the NEO Exchange, and they're shown on the screen. So if you can flip to the next slide, you can see the 18 that we have available. Thank you, perfect. And you're right, CDRs are modeled after ADRs. ADRs are a $1 trillion market that's nearly 100 years old. Actually, depository receipts exist in a number of countries around the world. Germany, Australia, UK, Brazil. And the primary reason for them are to either maybe get around some sort of regulatory restriction or deal with the fact that the US has a different time zone than countries like Australia or Germany. And as a result, there never was really a need for depository receipts in the Canadian market because there aren't any regulatory restrictions preventing Canadians from buying US shares, and we have the same time zone. The rationale for creating CDRs was different. In speaking with clients over the past few years, it has been very clear that Canadian investors wanted help managing their currency risk, and that they needed it because their global equity positions within their portfolio was growing relative to the Canadian equities that they were holding. And unfortunately, there hasn't been an easy way to manage that currency risk until now. We've seen a lot of interest, a lot of growth in the program. Actually, we have our next slide here shows just that AUM growth of the assets under management. And it's a lovely slide, bottom left to the upper right. This is in assets under management through 300 million. Actually, as of this morning, was 315 million. So it just continues to go higher. Trading volume, Alex will talk about it later. So we continue to see interest and growth, and we're over the moon excited about the future for this platform.
Tremendous, and a pretty amazing update. And obviously that chart looks just phenomenal. It's something that I'm sure you hoped and dreamed for, and it's great to see reality coming true. Maybe Alex, a good segue from Elliot. You know, what exactly are the benefits? What client issues are you tackling in addition to the currency hedge that are a benefit both for our audience, do-it-yourself investors, and perhaps their advisors that might be looking at CDRs to see how they could be of benefit?
Sure. Yeah, I can cover that. So there are three primary benefits of CDRs for Canadian investors. The first is access to global companies in Canadian dollars. You know, typically to get access to foreign companies, you'll need to convert your Canadian dollars, which can be costly and have an administrative burden. And with CDRs, there's no need to do that conversion and deal with those FX transactions and fees. The second is the built-in notional currency hedge. So this currency hedge will effectively eliminate any impact on the investor's return from moves in FX, helping to reduce reporting noise for investors, as everything will be in Canadian dollars and performance will mirror that of the underlying. It also provides the opportunity to take some risk off the table. You know, some advisors have said to us that for some of their clients with positions in registered accounts where we have names as a CDR, they'd like to reduce the risk for the client by selling the underlying share and then reinvesting in the corresponding CDR. And then finally, the fractional share ownership feature. So this feature can be useful for when you're looking to add, high price stocks into accounts of smaller size, perhaps those that have contribution room limits like an RRSP or a TFSA. And it really provides the investor to have more control in creating their desired portfolio allocation. Or if you're an advisor and you're looking to add these names across your book, through a model portfolio where some of the accounts that are included in this model are smaller, CDRs can help achieve a consistent portfolio weighting across those accounts. Or alternatively, we've heard some advisors actually replicating their main portfolio in smaller accounts, and they'll use the CDRs to do that.
Brilliant. The fractional share one seems to be one that certainly has resonated with the street, and I think everyone's starting to get some exposure now too to the currency hedge benefit. It's just an incredible set of features that you've managed to glue together to create the CDR and then ultimately to benefit investors. You've been out on the street now, Elliot, for the last 4 months, talking with advisors and investors, and I know, coming up with the CDR product in the first place probably had a good year or two's worth of dialogue and discussion to make sure you got it just right. Alex, you hinted at it, but Elliot, for you, what types of investors or clients are CDRs originally targeted at, and do you think you're hitting that audience?
Yeah, well, it was not a year or two; it was 3 years in the making, and actually, the initial vision or need came from an investment advisor or investment advisors that were looking for assistance. Listen, we think that there are 3 client segments that would benefit from CDRs. The do-it-yourself channel you've mentioned, investment advisors, and some institutional investors. Our early indication from the data that we have is that the do-it-yourself market, through channels like Questrade and Investors Edge and Waterhouse, that they represent about 2/3 of the trading activity that we're seeing and the assets under management we're seeing. We're starting to see, and we have seen, block trades come through from advisors, but advisors are also using it in a similar fashion to the DIY channel for the smaller accounts. So we're seeing a lot of advisors that we're calling having already participated, even though we haven't seen block trades from them. We're seeing them on the smaller transactions for some of their smaller accounts. And then on the institutional investor side, you try to make the comparison to ETFs. And initially, ETFs were created for a do-it-yourself channel to reduce fees on mutual funds. And then advisors were the second to adopt it. And now, I don't know what the percentage is, 40% of the ETF market is institutional investors, some crazy stat like that. It's possible that institutional investors will jump into the CDR market. We've had discussions with a number of asset managers. The particular solution that they're looking to, or the problem they're looking to solve for, is with regards to SMAs. So they run their models for these separately managed accounts, and currently there's no way to manage that currency hedge from global equities in SMAs. So we have had a bunch of discussions on that, and that could be, maybe I'll call it the third evolution in terms of the stage of growth from a client segment perspective.
Like it. Well, here's a question actually from our audience that maybe ties together, and it's more about the usability of CDRs themselves. But you've had 4 months of trading now. I think you've been through a number of pretty interesting market events over the course of those 4 months. The underlying shares, you both mentioned over the course of your answers so far. If one of your underlying CDR stocks does a split or a consolidation, how does that impact the CDR itself, out of curiosity?
Do you want me to take that one, Elliot?
Sure.
Yeah, so we're going to be monitoring what the underlying issuers are doing, and we will make the appropriate change on the CDR. So if it's a stock split or consolidation, we'll ensure that our CDR ratio is adjusted accordingly. If there's, for example, a name change on a company like we saw with Facebook switching to Meta platforms, we'll make the corresponding change on the CDR. That extends also to any sort of other corporate actions like dividends, for example. When the underlying issuer pays a dividend, we'll then declare a dividend on the CDR as well.
Excellent. So you've seen a bunch of fun already, and I almost forgot about the Facebook change to the metaverse. It's good to remind the audience that you're ultimately tracking and managing the underlying kind of shares that come into the CDR and making sure that it gets reflected in Canada as well.
Yeah,
I like it. Then maybe Alex, one back to you. A question ultimately, I'm sure you've been looking at and hearing from both investors and from advisors. CDR is a Canadian product listed on a Canadian exchange. How do you treat the underlying share from a foreign property perspective? Is the CDR in fact tackling some of those things, or is it still foreign property?
Sure. I'll tackle that question by going through maybe a bit of a comparison between the underlying, buying the underlying or trading the underlying directly versus the CDR. So Eric kindly put up a nice table that we have prepared showing the similarities and differences. So really, there's a lot of similarities between direct investment and the underlying share versus the CDR. Both are exchange listed, eligible and registered accounts, and have entitlements like dividends. As with the underlying share, T1135s will be applicable from a foreign property reporting perspective, and also withholding tax may be applied for dividends. So it's really important that investors make sure they have their appropriate W-8 forms completed on file, so that the proper withholding is applied in their accounts if applicable. Similarly, purchasing the CDR is done in the exact same way as purchasing the underlying share. So regardless of where investors have their accounts and what trading platform they use, they can buy or sell CDRs. They've been designed to look and feel like owning any other equity really in their portfolios. And where they differ is really where you see the value propositions of investing with CDRs. So that's the Canadian dollar denomination for trading and dividends, the currency hedge to protect against any currency fluctuations between the US and Canadian dollar, and then of course the fractional share ownership. And all in all, we're really trying to improve the process, lower the cost, and reduce the risks, and ultimately remove barriers associated with global investing.
And incredibly important, and obviously you've taken a lot of time and consideration when structuring the CDRs in the first place to kind of come up with a full solution that tackles a number of investors' needs all in one very pretty CDR package. We love it, and our audience is having a lot of fun with them too. I'm sure you've noticed a lot of questions piling in, so appreciate all of you sending them through. We're working through them over the course of the presentation. We'll keep weaving them in, keep them coming. Now, we all know nothing good in life is free, especially the good things, and CDRs seem to have a lot of amazing things all piled into one innovative package. What's the catch here? What's the business? Where are the fees? Elliot, maybe that one's for you.
For sure. So you're right. Every depositary receipt in the world is issued by a depositary bank. And every bank in the world is a for-profit organization. CIBC is the depositary bank for CDRs, and we're a for-profit organization. Where do we make our money? We make our money for managing the currency hedge. And maybe I'll take you to the next slide, which is a tracking of performance slide. Perfect. So this graph here compares the return profile of the Amazon or AMZN US listed share and the AMZN CDR. And this is 4 months of tracking. And as you can see, it's mirrored the performance almost perfectly. And we could talk about days that it didn't, and it's generally because of either trading volume at the close, or if it's because of holiday in one of the markets versus the other. But over this entire period, the performance difference has been 0.25%. And so that's kind of to be expected. It's basically impossible to track things perfectly when you manage a currency hedge. It's not a theoretical exercise. There's actually hedging activity that goes on. And there's a few reasons for it. But the biggest reason is because this is where we're making our money. So we disclose this in our prospectus. We disclose this in our brochure. It's on our website, and I think in our FAQ. So a bunch of different places. We can earn up to 0.6% per annum as a spread that we apply onto the managing of the currency hedge. If you try to equate that to a daily tracking, that works out to be about 0.0024% per trading day. Every depositary receipt, like I said, is issued by a depositary bank. Some of them charge money on spread and on the dividends. Some of them charge a management fee. To our knowledge, we're the only depositary receipt in the world that has a currency hedge. And so we just decided that was the best place to put it. The spread is in line with where currency hedged ETFs When they enter into currency forwards with banks, our fees are in line based on AUM of where those funds pay. So we think it's a very fair price. And while that is a cost, we believe that investors are more than compensated from an overall price or competitive cost perspective, because we've taken out one huge element, and this is Alex mentioned it, we've taken out one huge aspect of global investing, which is that first part, which is the converting of your Canadian dollars to US dollars. And on top of that, they don't have to deal with that administrative transaction of converting their Canadian dollars to US dollars. So by saving that 1% coming in or 1.5% coming in, and then 1 or 1.5% coming out, investors are materially advantaged from an economic perspective. And there's this currency hedge, which they would otherwise have no way of doing, because there's really no easy way to manage the currency hedge if you're a retail investor.
Plus the fractional. You're going to be having.
For sure.
Absolutely. No, it's a lot of challenges still for Canadian investors, and CDRs seem to go a long way in tackling a number of those, especially for the retail investor, but certainly into advisors, Alex, as you mentioned as well. Now, Elliot, when you were chatting there, you also mentioned a few keywords that I think, investors who have tagged into ETFs over the years and learned to implement those in their portfolios. We've got a few questions in the question box about liquidity, and it's probably a natural segue into that dialogue as well. And Alex, maybe this is a good one for you.
Yeah, sure.
Getting it often. It's not a question, or it's not a new question, rather, at the same time, but it is often a misunderstood buzzword. So, Alex, maybe turn it over to you for a bit of a walkthrough on liquidity and CDRs. What does it mean? What should investors be looking for?
Sure. Yeah, you got that right. The question of liquidity and low trading volumes is one that often comes up in the context of ETFs, and it's the same here with CDRs. So similar to ETFs, really to assess the liquidity, it's important to look through to the liquidity of the underlying asset, which in this case is the US share. So it's possible for the CDR to have a low daily trading volume, but also still be liquid with a tight bid-ask spread. And right now, and will continue to be the case, that CDRs reference highly liquid global shares that trade on major exchanges around the world. And generally speaking, where the underlying share is a high degree of trading volume, then the corresponding CDR will be expected to also have a high degree of liquidity. Now, I'm saying this, talking about low trading volumes, but we actually have seen CDR trading volumes increase over time. So if you go to the next slide, I think this graph really demonstrates this. And I'll just share some stats comparing late this summer, early fall to more recently. So in August and September, the average number of trades we were seeing per day were averaging around 400, and this has really grown to over 5,000. And this is across, multiple CDRs, the whole program. And then looking at the daily value traded in August and September, it was generally less than 5 million. And now we're regularly over 15 million a day, with some days over 20. And then looking at the perspective of trading activity on a single CDR, on single CDRs, versus looking at the whole program, as I just mentioned some stats on that. In the past month, we've seen some days where there's 10 million in notional trading on a given CDR. And I'll point out that actually Tesla CDR has been the most actively traded security measured by value perspective on the NEO exchange on many days in November. So that was really exciting to see.
That's huge.
There were some slides on that, Eric. I don't know.
Yeah, actually, if you go to the next slide, I think the next slide has, there we go. So you can see the trading activity has really picked up over the last 4 or 5 months. So it's really, really great to see.
And a key point too, and it's maybe tied, and it's a message we routinely get out and support as an exchange amongst the investment community. Volume's great to see on screen, of course, but it really is the liquidity of the underlying, to your point, Alex, that matters here. And we've seen, I think you guys have seen a couple of very large block trades as well, not just on small incremental trades, but advisors moving in $1 or $2 million chunks at a time.
Oh, even up to 5. We've seen 5 million across the portfolio, which is awesome.
and all done at a single price, smooth, nice, and well executed. And that's, I think, the kind of confidence that moves you from retail small accounts in the advisory business. And Elliot, as you were mentioning, gets you closer to that SMA and institutional solution as well, which CDRs are capable of performing. Brilliant. Maybe since we've got a few questions in the question box as well, just perhaps bears repeating around taxation on CDRs. So I know you covered it. They're treated like a U.S. security. Is there anything different that an investor should be aware of between registered versus non-registered accounts with CDRs versus if they held the underlying security specifically?
Nope. So they should expect it to be the same. And Elliot mentioned this, I believe, earlier. We do some FAQs on our site and other brochures and legal documentation that cover that. But no, the expectation, that be the same experience.
Yeah, there's no trust or anything like that between the clients and the shares in the account, and so that's why the tax follows if they held the shares directly. Perfect.
Maybe one that I can answer for a few folks in the audience as well before we tag into the next set of questions. A few folks have reached out to us as an exchange over the course of the last 4 months about percentage differences between the Canadian CDRs trading performance versus the US shares and how they move on a daily basis. The stock answer, and if any one of you in the question box wants to reach out, happy to provide you a bit of a set of examples that you can see over the course of the day. But our CDRs trade from 9:30 until 4 o'clock, and that's where our reference pricing is all keyed off of, and that's how the percentages on the CDR will show up on your client accounts and in websites on a day-over-day basis. US shares, especially for CDRs, they're very active in pre-market and post-market. And depending on the website you might be looking at or referencing over the course of your own analysis, might be starting from a different price than where the CDRs will start trading at. So while, Elliot, on the previous slides, you were able to show very tight tracking between the CDR and the underlying, there are different reference points for start of day and end of day between the Canadian and US markets that'll make those percentages, at least from a public website perspective, look a touch different. So that's maybe just one perhaps to address.
Yeah, I'll add to that 2 things. So the first is on days when the Canadian market is open and the US is closed. So like US Thanksgiving as an example, we got a lot of people reaching out to us and being confused. And it's I think value add that we're providing to our clients, letting them have liquidity on those days, even though the US market was closed. And so if they were to look at things from, I'm going to again use the US Thanksgiving, which is a Thursday and then half day Friday. But if you look at the price from a Wednesday close to, Monday close, the tracking is perfect. But, the Thursday and Friday trading in the Canadian market will be based on supply and demand. And so I don't remember which share it was, but I remember one of the shares, I think it was like PayPal or something like that.
I think it was PayPal.
Yeah, there was some news. And so the CDR actually was well bid. And so even though the US market was closed, the CDR was up like 3%. And then on, Monday, the US reference share was kind of flat, from Wednesday. So it was down 3% in the Canadian market. And we had a lot of clients call, say, how come your CDR is down 3% when the US share is flat? And we had to show them over that 3-day period what had happened. And so it's all in education. The other is on when we launch an IPO, like of a new CDR, the reference price from day one is actually a day stale because the bulletin that NEO sends out is based on the previous day. So we got questions on the first day we launched. Everyone's like, "Oh, your thing doesn't work. It's why doesn't it work?" And it just doesn't work because the process that we do IPOs under typically doesn't have something that changes in value from the time the bulletin goes out and on the shares list. So anyway, nuances that we learn over time and thankfully have been able to overcome.
Indeed, and all good things to point out because inevitably the question does and will continue to come up as you launch more. Maybe a good segue, we've shared a lot of intel, answered a lot of questions, two quick ones before we maybe proceed to the next one. Berkshire CDR, dash A or dash B?
That is class B. So on our website, actually, we have the CDR directory, and you'll be able to see the underlying share ticker there as well.
Brilliant. We'll pop that into the chat box and make sure we follow up with that one afterwards. So 4 months in, based on everything you've shared today, and from the outside looking in at CDRs, as much as I'd love to say they're an overnight hit, it's 3 years, Elliot, to your point of building, I think the right product, something that addresses investor needs. 4 months of watching this grow, expand, scale. You've been launching quite a lot of product, a very rapidly growing shelf, I think, versus your original plans. Seems like you're back every month with us to welcome a new batch of CDRs out to market. We've got a few questions in the question box as well. What's on the horizon? What's next? What can you share with our audience today around plans to keep expanding the CDR product shelf?
Yeah, listen, it was 3 years in the making. We didn't spend 3 years in the lab to launch 5, but we also didn't think that we were going to launch 18 by the 3rd month of the programs from the inaugural launch of the program. Actually, our initial plan was to be at like 12, maybe 15 after the first 12 months. But this is a product that we're building for our end clients, and we're getting lots of positive feedback. The media was very positively, responding to the launch, and so we expedited the rollout of our tickers based on feedback that we received from clients. And the specific names that you see here are names, other than the first 5, which we had filed in our first pricing supplement, which are the kind of the FANGMA kind of stocks that you would expect. The subsequent 13 are based on feedback that we received. We have another batch coming in January. Again, it's based on the feedback. And actually, you already can find out which of the next 6 are going to come out because they're already in our publicly filed pricing supplement, and so you can find that on our website. I don't have the names off the top of my head, but I think J&J is one and NVIDIA is another. So again, names that that we receive lots of interest in, and so that's where we're going to grow. From here, where do we grow? So we'll be 24 in January. Very likely could see us in the kind of 35 to 45 range by let's call it the April to June timeframe. But we're also getting lots of interest in other applications for CDRs. And I saw one of the questions about non-US. So we are looking at all of that. And US is a great place to start because the largest companies in the world all happen to list in the US. So it's easy from our due diligence perspective to just look at one regulatory regime. But the world's a big place, and so we're going to continue to look at our expansion plans. Again, driven by client demand.
Yeah, I'll just add, if you guys have any suggestions for those non-US names, we'd love to hear that.
Or US names.
Or US names, both names, both names. But
yeah,
yes.
So actually, last point on that is, so we'll get to like whatever our steady state is, 35 to 45. But then from there, if there are, we're not going to stop there because, the next Tesla is looming somewhere. And so to the extent that we get feedback on additional US names, we will continue. It's super easy now that we have a platform, as you can see. We just basically throttle up the engine and we can launch more.
Oh, it's incredibly encouraging, and you guys have done an impeccable job at collecting feedback from the street as some of these products have made their way out, soliciting for your next batch. For those of you in the crowd, if you don't have our respective sets of email addresses, there's definitely a form on the NEO website where you can click to request, and we'll make sure our issuers, CIBC, Elliot, and Alex, get those names so they can factor them into the next batch of paperwork to be filed. I'm impressed, guys. Like 30 minutes has ripped right by. I think we've managed to tackle a whole host of questions that have come in from our audience, and seeing some really encouraging words here. Lynn, obviously, thanks for the comment. Best thing to come since ETFs, and that's a tall order considering the amount of time it took to kind of build the ETF ecosystem. Elliot and Alex, you've got a ton of fans, obviously, in the crowd, and I think you've got a very captive group of folks that want to keep buying into these things going forward. But I did promise we would manage the schedule accordingly and not overtake folks' afternoon. So I'll maybe just turn it quickly to each of you for a quick 30-second wrap-up. Anything else that you think you've come across over the last 4 months that you want our investors to hear about from you guys direct? Otherwise, we'll work into closing remarks.
Elliot, I'll let you
Yeah, I just want to, I'll close by just thanking everyone. It's been, I've been in this business for almost 20 years, and it's not every day that you get positive feedback like Lynn wrote here. For the first while, Alex, myself, and another two gentlemen were the contact information on our website, and we would get 3 emails a week, sometimes 3 emails a night thanking us, which is unusual to be in this business and to get those kind of notes. So we didn't build this for us. We built this for as a solution for clients. So to the extent that you have comments, suggestions, please continue to send them our way. We will definitely take them into consideration, and we thank you for your partnership. And I guess the last thing is, when we built this, we were hoping that we could revolutionize the way that Canadians invest in global companies, and it's still early, and it's still only 4 months in, and really only 3 months for most of it. But looks like we're on our way.
Love it. Alex, any parting words?
No, I just echo everything that Elliot said. It's been super exciting to see this through from just an idea and then actually launching and then getting this feedback and seeing that it's really resonating with all the investors is really great to see and very positive. So yeah, thanks.
And happy holidays, everyone.
Yes.
Tremendous. Well, Elliot and Alex, definitely over time, and we'll have to make sure we allocate a few extra minutes the next time we have you back to celebrate these, because it's clear there's lots of demand, lots of questions, and a very engaged audience among us. We covered a ton of ground today about CDRs and the way that they're just taking over the street inside all of our different client accounts. So really appreciate you both joining me today for sharing a bit of a primer on how you came up with the idea and where you guys are headed, and sharing that strategy with our investors. I appreciate your time, and judging by the number of folks sticking through all the way through the webinar today, I'd say they did too. We're excited to see this product continue to transform the way Canadians buy global. You're doing all the right things for investors, and we couldn't be prouder to be a partner as you engage with our audience. So happy Thursday, everyone. Thank you very much for your time, and we look forward to seeing you on screen for another market open soon. Have a great one.